Guys, we're on the Dow at least back above yesterday's high, within a stone's throw of 30K once again. Let's get to Bob Pisani. Morning, Bob.
Good morning, Carl. Somewhat flattish open, but December so far at least is looking a lot like November, and that's generally a positive thing given the November numbers. Let's take a look at the sectors today. Once again, in the 2.5 days of trading that we've had, bank stocks, energy stocks have been leading the way, but technology's also been up this week in general, so that's pretty good here. Again, a little flattish here, as you can see, but by and large looking a lot like November. Consumer staples and some of the other more defensive names are generally lagging the overall markets. This is just in the first 2.5 days, but again, still pretty positive overall. Just want to highlight what's been going on with the airlines. We had positive comments from Delta, of course, but the Jets ETF, which is the main airline ETF, has seen huge amounts of trading and creation of new stock in that particular ETF. So a lot of interest. I think some of this is retail. This is the highest level for this ETF since going back to March, believe it or not. And even though it's down compared to where it was in February, it's had quite a climb back. And the amount of stock that's been created around this, amount of interest in airline trading has been huge in the last couple of months. Really one of the big winners in the ETF space this year. In terms of the market movers, of course, we've talked a lot about sentiment. We've talked a lot about how there's extreme bullishness that's out there overall. We've talked about how the earnings are kind of in a tough situation right now. Very, very high valuation. So here you see the second quarter. We had $27 for the S&P 500. These are the estimated numbers for earnings for the S&P. Q3 was the big move that we saw to the upside, $39. There's the big rally in the stock market. But we've been stuck since then. We keep waiting for the numbers to go higher for the fourth quarter and for the first quarter of 2021. But you see, they're stuck there, about $37. They're below the third quarter. Well, this is a problem. You got prices going way up and the earnings estimates going nowhere right now. So we've got a real valuation gap right now. We're talking about 22 times 2021 numbers. That is extremely pricey. And yes, the economy is improving. And when the economy is improving, you can have a higher multiple. But 22, that's a pretty pricey multiple. And 19 times 2022 numbers. So they've already got 2022 estimates out there. Bit of a risk now for the markets. Bullishness, really extreme. We look at a simple one. This is the American Association of Individual Investors weekly survey. Several thousand of their members here, 49% bullish. That's the second highest reading going back nearly 3 years. Bearishness is really low. That's the lowest level since early January there. This is a simple sentiment indicator, but you get the idea. All of these sentiment indicators are really at extremes right now. And you want to keep an eye on that when you've got very high prices, very earnings that are not keeping up with the prices, and extreme levels of bullishness. Finally, Carl mentioned that the House bill that passed late yesterday that would delist Chinese firms listed in the U.S. if they didn't cooperate with U.S. regulatory authorities. It's not moving the big names here, as you can see. I think the key story here is delisting would be very disruptive to the global ETF business, the global mutual fund business. These companies are listed in all of these emerging market and global mutual funds and global ETFs. So delisting would be very disruptive. It's not moving them right now. I think there's a couple of reasons. First, it's very likely that some kind of deal will be reached here in the next 6 months or so. Some deal where the Chinese authorities would allow U.S. regulators to sit and examine the Chinese audits and side by side with Chinese regulators. Now, remember, this is not about doing an audit. It's about simply reviewing the audits. They have not been allowing U.S. regulators to review the audits, and that's been a thorn in the U.S. regulators' side with their relations with the Chinese. That may get a little bit better. Finally, also remember, these companies are now, Carl, many of them are now dual listed in Hong Kong. So there is access to foreign capital if they eventually need it in the event of some kind of overall meltdown in that situation. I don't think it's going to come to that, though.
Shepard Smith here. Thanks for watching CNBC on YouTube.